If you're ready for freedom from the grind, then passive income from real estate investing is the best way to get you there. If you don't know where to start or what to do next, then the Rent Roll Radio Show is the best place to get you there. Join us while we discuss the best practices, strategies, and mindset you'll need and give you actionable content to get you from where you are to where you want to be. Hey, Rent Roll Radio listeners. As always, I'm your host, Sterling Chapman. I am back with a guest. He is our first three-peat guest. This is the third time he's been on our show. He is one of our favorite thought leaders and has been since we got into the space. So I was excited when his marketing team had mentioned that he would grace us with his presence again. Although I will say we lob softballs to our favorite thought leaders on their first and second tour. But round three, you're getting the hard questions today, Neal. The mad scientist of multifamily. The mad scientist of multifamily himself, Neal Bawa. Neal, thank you so much for joining us.
Thanks for having me back on, Sterling. It's been fun the first two times, and the third time, I'm ready. Don't give me any softballs this time.
So for our listeners that started later in the show and are not as familiar with who you are, can you give us a brief rundown of your history, your past, and kind of what you're doing today?
Sure. I'm a computer science graduate and a data scientist by profession. Had a successful tech career for 15 years, ran a company, sold that company. And I invested in real estate for a decade with my own money, no investors, learned a bunch of things, screwed up a bunch of things, and then started to use data science to publish data about where to invest in real estate. Currently, about 12,000 people on udemy.com are taking my real estate data science course. And I have about 1,000 very nerdy investors, a lot of them from Silicon Valley, that have invested with me, and I've been able to build that into a $1 billion database with 30 properties in 10 states.
Awesome. And for our listeners, I first met Neal in January of 2020. Wow, the world's changed 6 times since then. But I saw him on stage at Joe Fairless's event, and he basically broke down his data science approach towards market selection and neighborhood selection within markets. And to this day, somebody asked me a week ago, how do I know what a good market to invest is? And I forwarded him Neal's workbook that he sent me in January of 2020, because that's still the kind of best way to break down those markets that I find. And whenever somebody sends me a deal that I've never invested in that market before, if it's not one of our core markets, the first thing I do is I run that city through your gauntlet. So love what you built there.
Yeah, a lot of syndicators obviously are very evolved in the way that they process this data, and many have their own tools and techniques and methodologies that may even be better. My goal was to give this to any investor, and that investor can then basically compare 2 cities in the US that they'd never even heard of, right? So, Lehigh Acres in Florida, I want to compare that with Washington, Utah. Right? Because I walked into an evening cocktail event and somebody said Lehigh Acres is great, and somebody else said no, Washington, Utah is better. Well, how do you compare these 2 places for real estate profits, right? And for real estate risk? And so the Location Magic Toolkit was designed to create a 10-minute long process where you can take 10 minutes to work on one city and 10 minutes on the other. And it'll be very, very clear to you at the end of that time which of those 2 cities is better. By the way, those are both great cities to invest in. They're very tiny. But I picked those 2 as examples because it's unlikely that anyone's ever heard of Lehigh Acres, Florida, or Washington, Utah.
So it seems like every time we're talking, the sky is falling, right? The first time you were on, we just kicked off COVID. The second time you were on, we were right about to hike interest rates, or we had just started. And so now we're sitting in the mess, which is the COVID and the interest rates and everything. And so what are we looking at today? What's your feel for the market? I know I saw you a couple of weeks ago in Salt Lake City, and you were on the sky is falling train. Are we still there? How do we feel?
The sky is falling slowly. The answer is that, and I'll slice and dice it up into single family, multifamily, and commercial real estate. Single family is doing really well. Nationwide prices are only down 5% when adjusted for seasonality, which is an amazing number. I thought I was on the camp of people that thought that by now single family prices nationwide would reduce by 10%. There are some bubbly markets like Austin, Boise, and Phoenix that have gone down 10%. San Francisco Bay Area gone down 12%. But overall, the single family market is standing up well, and that's because 99% of loans are 30-year fixed. So people are only selling when they absolutely need to sell. And that's created so little inventory in the marketplace that prices have gone down in a very orderly fashion. So the single family market is in a correction, and a gentle one, a slow, gradual process. The multifamily market is in a major correction, so a significant major correction. Some of the same things apply. Very few people are selling. Only the people that absolutely need to sell are selling. So there's very little inventory in the market, which means that cap rates, which is the mechanism by which we figure out, what a property is worth, are all over the place. For example, a very recent CBRE report shows Class A value add cap rates in Phoenix at 5.75. I don't believe that number at all. I think that number is, I'm sure that some property was sold for that amount. It's just the number of properties being sold in even major metros like Phoenix is so low. It's so choppy that the rates, and cap rates are everywhere. It is very clear, though, that cap rates have now risen by between 125 and 150 basis points in most metros for properties. Smaller metros, maybe 100 basis point because they weren't that low, right? So remember what happens with cap rates. When cap rates go up, prices go down. So cap rates were really, really low. In many metros, they were in the threes, and those metros are the ones where they bounced the most, maybe 150 basis points. So they're up, which means the value of those properties is down. For those of you that don't know, 150 basis point jump is a 26% reduction in price. So we are seeing that in some metros for some properties, there just isn't a baseline. So let's call it the sky is falling in certain metros in the US, and it's falling really, really slowly. Now, other metros are more in the 75 to 100 basis point difference, which could be half of that 26% number. So you're looking at a 13% price reduction. But I'm not seeing any properties in the US that are not down by at least 12 or 13% from their highs, the highs being the last quarter of 2021, the first quarter of 2022. Those 2 quarters were basically the peak of the market. And so we're seeing the market recede from that. There is, to my knowledge, no metro in the United States that has held its prices for multifamily from that peak to now. Every single market has reduced, has gone down. And the biggest reason for reduction is variable debt. The multifamily market has been so expensive in the last 5 years that the massive majority of debt that was of properties that were purchased, especially for the syndication mechanism, were variable debt properties. That's what worked. That's what people were using. Nobody was using fixed debt. Nobody was using HUD. And so all of those properties are now in trouble because their value has gone down, and a significant portion of them need to be refinanced. But that refinance deadline is not up yet, which is why we're seeing the sky fall slowly. And the third portion, which we'll discuss if you want to go there, is the sky is really falling, and falling completely for every other commercial real estate asset class except for apartments. So
I,
there's a very significant level of distress there.
I'll bite. I don't know how
All
I
right.
couldn't bite. Go on.
All right. So yeah, so that third bucket is everything from self-storage to hotels to retail to office. And of those segments, the one that is in absolute slaughter mode is the office market. Because of work from home becoming sort of a thing where companies are, saying, hey, you got to come back in the office. I'll give you, 1 day off or 2 days off. Right. So people are coming back to the office, but so it looks like about 20% of the companies just decided to stay remote. 80% of the companies said come back to the office, but even the vast majority of those companies, especially the large companies, said we'll give you 1 day or 2 days a week. Now you might think, well, how does that reduce office requirements? The answer is almost every company that I know of is moving to sharing desks. So as desks are being shared, some people are not coming in on Monday and others are not coming in on Tuesday and Wednesday. So office space requirements have decreased extremely radically, leading metros like San Francisco to basically look like ghost towns. And so office revenue is down 30 to 40% in major markets like San Francisco, New York. A lot of markets are extremely, extremely affected, and no one wants to lend on office. So when your property comes up for renewal, or when you want to sell it, finding debt is astonishingly difficult for office at this point in time. Now, retail's in a better position. There's really nothing wrong that I can point to as far as the retail market is concerned, because the retail market was not overly bubbly. They didn't overbuild. There really hasn't been a lot of retail construction in the last 5 years.
You know what I think? You know what I think has kept retail in check
Mhm,
is the
mhm.
the long and slow fear of the internet, right? Like Office kind of slapped us on the back of the head overnight with COVID, right? We've been seeing shit go online for about 20 years now. Like the idea that Toys R Us was going to go out of business
Yeah,
because you could order them on Amazon, like we've been incubating that in our head since 2007. Like it wasn't a, and I think the prices stayed low in that fear.
yes, and I think that fear is what has saved retail. Um,
Yeah,
in that retail has not had an apocalypse, it's not had a full debacle. It's been sort of a gradual decline, low amount of construction, which keeps things in a reasonable price range. So I think retail was actually in a good place. Unfortunately, and I would have said 6 months ago, retail was still in a good place. Today, though, you have to point out to the fact that 40+% of all retail loans are offered by small to mid-sized banks. And if you haven't been sleeping under a rock for the last 2 months, you know that we had this bank called Silicon Valley go bad. And after that, mid-sized banks lost massive amounts of money, hundreds of billions of dollars to the big banks, to the Charles Schwabs and to the Chase and to the Bank of
because
Americas,
people
right?
are afraid of the smaller ones going out.
They're afraid of the smaller ones going out. They're afraid of a bank run on banks like First Republic. First Republic had a very vicious bank run, which took their stock from $110 to $13 yesterday. So 85% reduction in stock value. I think they've lost 30 or 40% of their deposits, even though the entire banking system put $30 billion of their money into FRB to prevent it from going under and prevent contagion, which was, by the way, was a very smart move. The contagion was avoided. But FRB is simply a much smaller bank today than it was 45 days ago. Well, this is true of thousands of smaller banks where a lot of people basically are pulling their money out. And that money is going to take many, many years to return. Well, these banks were the primary sponsors of commercial real estate, with the exception of multifamily. And I'll explain why in just a minute. So if 40% of office funding was coming from small to mid-sized banks, if 40% of retail was coming from there, storage, not so bad. I think with self-storage is in a better place. Industrial, almost 40% of that funding. And now you have these banks that are looking at every asset because they've been asked by the Fed after Silicon Valley Bank's collapse to basically look at their assets and do mark to market, which essentially means if your asset has lost value, you need to go into your books and mark down its value. Well, now that's a double whammy. On the one side, you're marking down your assets. On the other side, money is getting pulled out of your bank as depositors are fleeing to big banks. So now you have a double whammy. And so your ability to create new loans for retail, for office is down, not down to zero. But I think that I think I would speculate that 60-70% of all lending available to those asset classes has vanished. Multifamily is lucky in that the government has a mandate to provide loans to multifamily, and that mandate is fulfilled by two entities, Fannie Mae and Freddie Mac. Those are very large entities. They have hundreds of billions in loans. In fact, they have more money than they know what to do with because until 2022, Fannie and Freddie were running out of money. This year, I don't think that they're gonna even spend half of what they're supposed to spend each year because there's so little volume in the multifamily space. So they're doing fine. There's plenty of money available. They're happy to lend to anyone. So the multifamily market is liquid because of this mandate. Unfortunately, there are no mandates to provide lending for any other kind of commercial real estate space. Only multifamily and single family have mandates. Also, because of this mandate, multifamily has never hit 20%. So we've never had an instance where more than 20% of multifamilies were financed by small to mid-sized banks. The current number is 19%. So I'm sure some of that 19% is affected. Let's say half of it's gone. Well, you're still good because you still have 90% of the financing that you used to have, maybe 80% because CMBS is gone too. So there's lending and liquidity challenges in the multifamily industry, but there's lending debacles in the rest of the CRE
Mhm.
industry in the coming 12 months.
What about self storage and industrial?
So both of those asset classes are doing well. So as an asset class, I think both are in a good place. Self-storage has to be a little more careful because there's a lot of supply coming on. Industrial actually has more supply coming in than self-storage, but the demand for industrial is so robust that that supply may be absorbed, maybe partially, maybe fully, but I think that the absorption rate for industrial right now is pretty high. Some of it is because companies are reshoring some of their activities from China and other places to the US, not large amounts, some. But think about it. China has 1 trillion square feet of, industrial real estate. If you take 2% of that back, I mean, you're looking at an astonishing amount of space in the United States, right? So I think maybe 1% or 2% of Chinese manufacturing is going to return to the US. Well, the primary, asset class that benefits from that is industrial. So there's still some tailwinds for industrial. Self storage has a lot of supply coming in, so it could get hit. So it's sort of a wait and watch situation. A lot of self storages are fairly small projects, so I think that the banks might still be fairly liquid on those. It's just a wait and watch, Sterling. I don't really know how these two asset classes would do. If I had to say one will do better than the other, I'd say industrial would do better than self storage.
So now for the hard questions, real quick. And shame on me for not knowing this. As long as I've known you, your corporate structure. Are you a fund, or you're managing, operating, buying, acquiring too, or do
I
you
am.
invest in? What's
I'm a
your
hands-on in the trenches syndicator and developer.
Okay? That's
Other
what I
other
thought. I
people
just want
put
to make
money
sure.
into my projects. Other people put money into
Right,
my
right.
project.
I just wanted to be clear. So then my next question is, we talk about everything that's happened over the last 36 months in the multifamily space. So Neal Bawa, over the last 36 months, have been very active in the multifamily space. So are you feeling these pains that you're describing other people? Did you make some of these decisions? Did you make other more conservative decisions going into the last 36 months that you're insulated from these risks? And if you didn't, what are you doing to pivot now?
I was lucky. I can't say that, that the decisions that I made in the last 24 months did not have an element of luck. I have only purchased a single property that I didn't already own in the last 24 months. Actually, now two, because I did purchase one very recently, but obviously it's at a much lower price. So I won't count that one. But when we're talking about these peaky, expensive three cap type of properties in that 2021, 2022 timeframe, I purchased one. I was very lucky. I purchased it at 5 cap actual in a true tertiary market called Killeen. So the number of properties that I purchased in bubbly metros during the rush was zero. Now, one could say this is because of my data. This one could say this is because I, simply know what was going to happen. I didn't know any of those things. I felt concerned, but luckily I had new construction projects running in the hundreds of millions during that time, and they kept me busy. They, used up all of my equity, and that basically I ran out of equity to buy apartment buildings. So I'm very lucky. And because I've been very lucky, because I only have a single property today that's bleeding, and its bleed is small enough for me not to do a cash call. Because of that, I have created a rescue fund. So a rescue fund, also called a pref fund or rescue capital, or top off equity, basically is designed to help those syndicators that may have overpaid, but hopefully they didn't do a 3 cap overpay. Hopefully they still bought something in the 4 cap range. They're now bleeding, the property is bleeding cash, but otherwise the property is doing well. So their business plan is working, but they're losing money because of cash flow issues. Well, those kinds of properties which exist, I can vouch for that because I've received a number of them as incoming applications from syndicators. Um, those properties we can top off in two different ways and prevent them from going back to the bank.
So luckily, you ran out of money before things got really out of control.
I think I was distracted. I suppose we could have raised more money. I think it's more honest to say I was busy.
That's great news. So, what is I mean, we know you have the rescue fund. What else is on your agenda for the next 12 months?
Um, Oddly enough, it's new construction, and you might say, "What? This seems to be the worst time to do new construction." The interest rates are really high, loan to values are really low. And I'm like, yes, that's why I like it, because today I'm able to do something that I was not able to do in 12 months or 18 months ago. 18 months ago, I had to buy land at outrageous prices. 18 months ago, I had to close on that land in 120 days, or in some cases, I had to go hard on day one. Well, now all of that has changed. So not only can I put land in contract for 9 to 12 months without basically putting down a penny, I also have the ability to negotiate on the price of that land, and basically, the price of land has gone down pretty
Eh,
substantially.
and that's hugely important in development because the you don't even know if you can build on the land when you buy it a lot, right?
Exactly. So we were taking that risk 12 or 24 months ago. We do have one property in Manor that we don't think we can build on, so we would probably end up selling it. Luckily, it's gone up in value, so hopefully we break even. We're not going to make money. It's just a year worth of wasted labor on those properties. So yeah, there's a significant risk. Today, I don't have to take that risk at all. In fact, in fact, there's so much, I wouldn't say distress, but there's so much of a sense of urgency amongst people who do land development, that there are people where I'm telling them, you know what, I won't pay you a penny. I know your land's worth $3 million. You invest into my development project and give me that $3 million as equity, so I'll count it as your LP investment in my project. And that
Yeah.
way, you don't have to sell it for, $1.5 million, because right now the market's illiquid. You keep the $3 million value, and then when 5 years later I sell my property, I've doubled your money like any other LP. Now you've made $6 million, but today you're going to
And
make.
would that defer the taxable event for them as well?
Most likely, yes, because there is no actual sale, there is no transfer of money. They are simply vouching that
Right.
land into my project. So their taxable event would be when the property is actually sold, right? So
Right.
and to do that, I think I have to give them like a 0.1% GP share or something like that for them to say, we're general partners in this property and we're making something from it. So things like that. I mean, those kinds of opportunities are pretty awesome. And I had zero chance of making that happen 12 to 18 months ago. So the other thing that I'm doing is I'm betting that interest rates will go down a year from now. So I'm making that bet, and I'm basically getting 12, maybe even more than 12 months worth of extensions on my land. So I don't even really have to buy the land for a long time. And even if I buy it and rates haven't reduced yet, I hold, because land is only 10-15% of the equity requirement. So I basically raise 15% of the equity, buy the land, hold, wait for rates to come down, and don't actually get the debt until rates come down. So I'm trying to ride the downward wave of the interest rates, which I think will happen in the second half of this year, first half of next year. And the goal would be to actually raise most of the equity and get the debt in the second half of next year. So this is a great time to line up new construction, because all of the factors are in your favor. You just have to be prepared to walk away from deals where you have to close on the land quickly.
So you're going all development, and your opinion is that, just to recap, housing market will continue to stay steady, slowly going through this. Multifamily about to fall off of a cliff, but then start to come back uh,
Fairly
first
quickly.
quarter of next fairly quickly,
No, I
and
wouldn't
then
say first quarter of next year. I'd say third quarter of next year. So I think that from today, the price of multifamily falls all the way to the first quarter of next year, maybe stabilizes in second quarter, and you will start to see an uptick in that price, because by third quarter of next year is when the rate cuts from the Fed are substantial enough for there to be significant improvements in the lending situation, significant improvements in LTV, and that should make a almost immediate impact on prices, because multifamily demand has been extraordinary because of the fact that there's all these office moguls that used to own amazing properties and towers that were 400-500 million dollars, and they don't want to put a single penny into office at this point. Their only other option, really, realistically speaking, from a perspective of size, is multifamily. They can't go out and do $4 million storage, self-storage projects when they're buying $500 million office towers. So that capital is looking to deploy in multifamily. From what I can see, it's not actually put any money in. It's just sitting on the light sidelines. It's patient. But the moment the numbers, the math works out, they will jump in. And the math is now beginning to jump in. I was pencils down on value add multifamily until April 1st. And so on April 1st, we started underwriting, and we made our first offer in Tallahassee yesterday.
awesome.
So I'm back on the
What
value add bandwagon. I was just gone for a while.
got it? What advice do you have for somebody who's just getting started in the space? What advice would you give to a Sterling Chapman in June of 20 or January of 2020, who's at his first multifamily conference, overwhelmed, doesn't know where to start?
You're lucky and you don't know it. Today, you're at a point where properties are 15 to 25% cheaper than 18 months ago. Today, you're at a point where debt is going to get cheaper over the next 12 months. No one in our industry believes that debt is going to become more expensive the next 12 months. I'd say if you polled 100 responsible syndicators, 95 of them would say debt is going to get cheaper 12 months from now. So you're in a terrific position. You're starting at a time of distress. That is absolutely the best time to start a business. Go read any business book, whether it's Warren Buffett's book or Bill Gates' book, all of them will point out to you that distress is what creates great businesses. Distress is what creates tailwinds and opportunity. There is distress in today's marketplace. You have two problems, and both of them are solvable. The first problem is equity. Investors that invested 18 or 24 months ago are now seeing cash calls. Yeah, they are seeing no return on their equity. They are seeing their pref, being uh, postponed. Their cash flow is zero. So they're hearing all this bad news about their properties from lots of different sources. And so at this point, they are not inclined to invest, which is a huge mistake. I mean, if you were willing to invest in a three cap property 24 months ago, today that property is 4.5 or 5 cap, and you're not willing to invest. This is about education. This is about telling investors you're doing the same thing again that you did in 2009. You didn't buy anything in
Yeah.
2009 simply because everything was going down in value. And then you promised yourself that you would never make that mistake again. You would be the Warren Buffett person. And today you're making the same exact mistake.
It's so hilarious how fundamentally, I mean, kindergarten level basic, the investing principles of like buy low, sell high, buy, you know what I mean? Don't sell it when it's going down and everybody's freaking out. Like that's just so 101. Like I knew that in the ninth grade, yet every ounce of our like human condition just fights it. I mean, just dude, I did the same thing. I bought a bunch of Bitcoin and when it was sky high and then it just shot down to absolute nothing and I sold it. 3 months later, it tripled. You know what I mean? It's just human nature to do it.
It is, and we make that same mistake all the time. I think investing, that most investors are actually speculators. So the vast majority of investors
Mhm.
are speculators. And it is our job, the new Sterling Chapman who's going to his first conference, his primary job is to write a wonderful presentation that explains to people why every single indicator today is better than it was 24 months ago, including debt, by the way, because there's a very, very, very high chance that debt goes down. Even the Federal Reserve, which has been much more conservative than Wall Street, look at their dot plot. It clearly shows that they're going to be reducing the interest rates, right? Now, 12 months ago, when you were investing, or 24 months ago, when you were investing, there was all this talk of the Federal Reserve saying, hey, we might have to raise interest rates. But you ignored that, right? And obviously, it didn't work out for you. The Fed has been very consistent. Once, they said transitional, once they got off of that bandwagon, which is about 17 or 18 months ago, since then, they've been very consistently saying we need to do a lot to contain inflation. They're saying inflation's very high. We need to do a lot. And by the way, they're still not done. They may still raise again in May. Might be one last raise there. Maybe not. The point is, the Fed's been consistent. Wall Street is the one that has basically underestimated what the Fed will do. And the Fed's really gotten to where they thought they were going to get about 6 months ago. So I think that we are on a path that's very clear. The Fed knows what they're doing. They were late to this market, shame on them, but now they're working hard to correct their big mistake. And I think that as a result, this is actually a great time to be getting into an asset class. I want to point this out to you. I do not believe that the problems of mid-sized to small to mid-sized banks will correct over the next year. I think it takes 3 to 4 years for them to correct. Well, if it takes 3 to 4 years, there's only one asset class that has mandatory lending,
Lendability.
right? So Fannie Mae, Freddie Mac, two huge institutions with tens of billions of dollars to spend each year. It's multifamily. The other asset classes don't have this. I'm not saying all of them will do poorly simply because they don't have any lending, but it's going to be very hard for them. And I think lending, multifamily is going to become very liquid as soon as rates start to drop because of something known as spreads. Banks, so when we look at the interest rate that we pay on a multifamily, it actually has two components. The first component is the Fed funds rate. That's the piece that the Fed is raising. It's expressed in the industry as LIBOR or SOFR. These are terms, but essentially what it means is the banks borrow money from the Fed at a certain rate. Right now it's at 5%. And then they basically lend that money out at 5%. The second piece is called the spread. The spread is an indication of the bank's risk. If the bank thinks that loans are riskier, they make the spread bigger. If the bank thinks a loan is less risky, then the spread falls to a pretty small number, like 1%. Today's spreads are ridiculously elevated. You can get bridge debt. There is no shortage of bridge debt. There is no shortage of variable debt, but the cost is very high because the spreads are absolutely astonishing. On top of that, 5%, people are putting in 3%, 4%, 5%, 6% even to give you bridge debt. But here's what happens. The moment the Fed stops, the spread portion collapses, not the Fed portion. The Fed portion is still the same. The Fed's just stopped raising. So that first portion is the same. But the second portion is just fear because the banks don't know where the Fed stops. That's going to collapse. Now, the first time the Fed cuts rates, which I think will happen in July or maybe, oh, well, no, maybe July is too soon, September. So September this year, the Fed cuts rates and they're going to cut by a small amount, like just a quarter point, right? So you get that
Right.
quarter point benefit. But then on the spread side, you might get another 1 point. Well, 1.25 point is a huge, huge change in your underwriting. It's a massive change in your underwriting. And all of a sudden, you need less equity to buy the same property. So here's the rule. Get a property in contract now and don't close it until October. Don't lock in your interest rates until October. Drag it out as much as you can. I don't think that the seller is going to like that, but sellers have less power today than they did 18 months ago. Buyers have more power, right? So bottom line is, I think this is a great time to put properties in contract and not close them.
What is your what is your recommendation on a tactic to do that without pissing off the brokers and the sellers and getting a bad rep as a retrader or somebody who doesn't close on time and all that? Like, how do you tactfully do that?
Pay them more money. Typically, to extend the property, what you do is you increase your deposit. Well, when you increase your deposit, you're not actually paying more for the property itself. And while I'm generally not in favor of paying more money just to get 30 more days to close, if there was ever good use of money, this is it. You can go back and say, hey, if I take 3 more months, I'll pay you $100,000 more for your property. Now, all of a sudden, they're happy about that because now they're getting something for it. They're not just getting more deposit. Deposit simply means surety of close. But $100,000 is $100,000 of profit that they're generating. Well, I do the math. When I look at a 1.5% change in interest rate on a $20 million property, or let's say a $25 million property, the math is hugely in your favor. I would love to give that $100,000 up because not only is it going to make your loan much cheaper, it's going to make your rate cap much cheaper. Rate caps right now are outrageously expensive. $35,000 rate caps are between $500,000 and $1 million. And
Yep.
the moment the Fed stops, the moment the Fed cuts the rates once, those rate caps are going to collapse, right? And so that 100 grand that you're giving up, you're going to make that back with just the drop in the rate cap, let alone your mortgage. So the answer is, this is a great time to pay a bit more. And then all of a sudden the seller is not as grumpy.
Yeah, for sure. Great advice. Great advice. Any other tips and tricks going into this
I
this
think,
potential market opportunity on the
yeah,
acquisition side?
Um, I mean, look at cap rate reports. I think normally what happens is cap rates in the US were so freaking stable that I sort of got fed up of looking at cap rate reports. They were telling me what I already knew. Everything is really expensive. Class A is expensive, class B is expensive, C is expensive, D is expensive. A property that should just be torn down is expensive. What am I getting out of cap rate reports? Today, though, actually, the cap rate reports are showing some very interesting data. There's markets, believe it or not, there's markets where cap rates haven't moved at all. Jacksonville hasn't moved at all in the last 12 months.
And where would you pull these cap rate reports?
CBRE has a cap rate report that's pretty recent, so you might want to go to the CBRE website and sign up for their free account, and you should be able to get the CBRE national cap rate report, and it's got all kinds of asset classes. So just scroll down to multifamily if you're interested in that, and other asset classes are in their office, all kinds of asset classes, and you'll immediately see that there's a huge metro to metro difference which didn't exist
Hmm.
12 months ago. So, right now, Phoenix, Atlanta are great places to invest in because there's more distress, there's more flexibility with buyers, with sellers in those metros. Florida is a terrible place to invest in right now because the cap rates haven't moved, which means that they will move in the future. That market is simply
Sure.
so buoyant at this point that it hasn't reacted normally to
How
cap
do
rate declines.
how do you feel about Texas?
Um, it's Texas is challenged. I am a big investor in Texas. Half of my portfolio is in Texas. So I hate saying this, but Texas is challenged right now because of a lot of things that they're doing. It's a state
Insurance,
where, I mean, they don't charge any sales tax, so they don't charge any state tax, and they're simply running out of
property.
infrastructure, and so they're basically loading on the property taxes. The taxes are going crazy. Insurance is also going crazy. So the double whammy of insurance and property taxes is making Texas much less lucrative today than it was. I think North Carolina may be in a better place.
Absolutely. No, that's the feedback and we've got a ton of property in Texas, and that's the feedback that we're getting as well. That is a good catalyst. I want to transition over to our radio round, which you have been through our radio round twice before, so we've
Yep.
altered it because I didn't want to ask you the same questions a third time. So I created a new list of questions that's actually a longer list because it's just things that I selfishly want to know while I have a really smart guy on the line. So I have altered the radio round to 5 specific Neal Bawa tailored questions. So the first question is, and this one is a nod to our previous list. We usually ask what's your favorite book, but I want to know what is your top 1 or 2 book recommendations for us as more of a current events thing. What are you reading today, or what do you recommend I go read today?
Um, what I find actually is today I want to be reading books that are written by people that have been investing for a long time. I find that in good
Mhm.
times, you read books of people that are doing .coms and kind of racing companies forward and things like that. In bad times, you read books from leaders that have gone through 3, 4, 5 of these. So if Charlie Munger or Warren Buffett has written a book, I want to read it. I've been watching YouTube videos with their latest feedback, and it gives you a sense of, like, you know good times are transitory, bad times are transitory too. And they point out that you typically have 80% good times and 20% bad times. Um, so to me, this this is actually a good time to read books about people that have been through a number of these crashes, because I think that they have better insights than the sky is falling or there's gold everywhere sort of crowd.
Absolutely love it. What is the top 3 conferences you recommend? That I know you go all over the country every year and attend them. What do you think are the top 3 that are going to provide the most value?
Well, at the very top, unquestionably, is the best ever conference. I find
Yep.
that it's the most structured. It's the one that provides the most value, and I see the highest quality of syndication. Folks show up there. Lots of passive investors show up. So it's definitely has been and will continue to be my favorite conference in the
Same.
U.S. So if I go to one, I'll go to the best ever conference. Michael Blanc puts on a good conference, and it's usually in Dallas, and I like that conference too because Michael
I
has a
just
lot
signed
of
up for it.
buddies, right? I have a lot of, he has a lot of buddies. I've presented at that conference a number of times. So just because of his network, he gets a very significant number of people at that conference. The third one is a non-syndication conference. I think it's very important to go to this conference because it's the NMHC. So it's becoming more and more important to go to the National Multifamily Housing Council's conference. The NMHC holds a conference. I think it's not called NMHC. I think it's called like NAA, like a National Apartment Association conference. So look at the NMHC website. It's a conference where you learn from people that have been doing this for much longer than we have, because,
It's
right?
NMFHC.
No, just NMHC.
Okay.
NMHC, National Multifamily Housing Council. So their annual conference is very powerful. It's also by far the largest, so there'll be like 2 times as many or 3 times as many people compared to the best ever conference. Sometimes syndicators that go there feel out of place. I urge you have to listen to these people. They've been doing it much longer than you have. They were doing it before the word syndication was even a word. And people that own for 20, 30, 40 years, they've seen cycles. In a bad time, it's best to listen to what these people are saying.
Awesome. Great advice. And do you have a third one?
Well, I gave you Michael Blanc. So Michael Blanc, best
Oh,
ever,
you're
and
right. I'm sorry. Perfect. Perfect. Couldn't agree with you more about best ever. Actually, just signed up for Michael Blanc's right before this call. Never been to
Mhm.
one of his events before, but I wanted to I wanted to go to Dallas, and I wanted to bring one of my teammates to the conference, so we signed up for that one. Love the feedback on the NMHC. Definitely going to go check that out. The next question is multifamily news or just commercial real estate news. What's your favorite news source? You're very in tune with the market and the and economics. Where are you getting all this from?
Um, Gosh, that one's really hard because there isn't a single source. My feedback is the lenders do a really good job, right? So Marcus and Millichap, Cushman and Wakefield, um, and who's the other one? Uh, those two have great CBRE. So the lenders have analytics teams because they provide analytics services to large syndicators and large, buyers. And so their analytics, which are really free, I mean, are absolutely astonishing. I read every single report. I mentioned three, but there's probably 10 of those in that group that I, read all of their information. Yardi Matrix, which is, a property management software, does an absolutely unbelievably phenomenal job. I attend every single one of their webinars, and they also push data out. They send a monthly rent report, which is my absolute favorite report of the month to read. Every single month, I consume that report. I read it twice, gives me a sense of where the trends are going. It does more than just rents, but it's primarily a rent report that slices and dices rents by large metros, small metros, things like that. What areas are going up, what areas are going down, stuff like that. So those are super interesting to me. And um I also like to read like mortgage daily news and stuff like that to understand what the mortgage world is doing, just
Yeah.
independent of even multifamily. And I get a lot of information out of that. And then I tend to read a massive amount that is not related to real estate. Real estate today is just a booger on the shirt of all the financial madness going on in the world. That's what we are. We're a booger on the shirt of the madness going on around the world. Everything that's happening with federal reserves, everything that's happening with rate cuts and with ridiculous amounts of sovereign debt, it's all impacting us in both positive and negative ways. So I think most syndicators don't have an understanding of this crazy, unbelievably stupid financial world out there, and you have to understand what that means for you. So Bloomberg, Market Watch are great sites to look at. So I'll go to Bloomberg first thing in the morning and understand what those guys are doing. I don't really invest much in the stock market, very rarely, unless I see a weird opportunity. But I do read their articles because I think they're well written. Wall Street Journal as well.
Awesome. That's a lot of great info. And then finally, what's your favorite market for the rest of the year?
Um, this markets with distress. I mean, right now there's more distress and higher cap rates in markets like Phoenix and Atlanta. For the longest time, I've been investing in smaller markets because the cap rates were higher. So I've been buying in Greenville, South Carolina, or buying in Killeen, Texas. Today is actually not a time to buy in tertiary markets because you're getting fairly good cap rates in some of the bigger markets. So I'm just paying attention to the cap rates. I think most markets are open because today I'm basically a buyer based on price, whereas in the past I was a buyer based on population growth, job growth, income growth. Today it just makes sense to focus on the price.
Okay. And we had one more question. I thought that was the last one. It wasn't. The last one is, where do you find most of your investors?
Um, Everywhere. I mean, I'm sure there'll be some investors that'll come out of this podcast. So I appear on 100 podcasts a year. I do about 20 webinars a year. We spend $500,000 a year on Facebook ads. Um, go to conferences, things like that, mine the web. I have a team that mines Facebook groups and basically puts them into a database. Then we market webinars to them, stuff like that. So it's very difficult for me to answer that question. Our YouTube channel is pretty terrific. So go to Multifamily University and you'll see fantastic amount of content. You'll notice that as soon as we post video, there are thousands of views on them. even though some of the videos are more than an hour long. So I think it's a multi-channel approach that works. Facebook ads are extremely expensive, so it's the top 20% of our funnel where we're like, okay,
Yeah.
we know these are really expensive, but the really cheap stuff is going to make up for the really expensive stuff, and our average blended cost of acquiring investors is going to be reasonable.
Yeah. Cool. So where can our listeners find out more about you, get to know you, invest with you, learn from you?
Two ways. One is type in my first name and last name into Google. I'm the only Neal Bawa on the World Wide Web, so everything good and bad that you read is about me. The second, more formal way is to go to Multifamily University, which is multifamily followed by the letter u.com. So that's multifamilyu.com. That's where we store 20 webinars a year. We have about 25,000 people that register for our webinars every year. And our webinars are about just everything that catches my fancy. Right now, I'm writing one on the impact of artificial intelligence on everything in the world. And in 5 months ago, I was talking about the impact of ESG and climate change on real estate. Anything interesting that catches my fancy, we present on. Of course, we present on things like what happened with Silicon Valley Bank, what is happening with the interest rate cuts. So things that I think are interesting to people, but are not necessarily just about multifamily real estate. That's the kind of community that we have. It's free. It's always meant to be free. There's no subscription. It's just a bunch of people getting together and talking about some interesting stuff.
That's awesome. Neal, thank you so much for joining us again. I appreciate it. I learned a ton. I took a full page of notes, and I'm going to walk away and I'm going to subscribe to these news stations, and I'm going to sign up for this conference, and I'm going to be a better investor because of it. So again, always appreciate you joining. Always appreciate the value you deliver, and look forward to keeping up with you on your journey, and hopefully seeing you at another conference again soon.
Sounds good. Thanks, Sterling.
This episode was brought to you by Crestworth Capital. If you're a busy professional and ready to make passive income from real estate investing, then go to crestworthcapital.com, where you'll be able to download a free copy of our ebook to help you get started today. Until next week, happy investing.